Hi, everybody. It's Scott Riley, the Market Update Desk. April 2nd, and believe it or not, the Detroit Tigers are in first place. They're one of only three teams that remain undefeated in Major League Baseball. They ended up winning last night in 10 innings on a huge go ahead 3-run home run. Kind of cool to see that they are starting the year off very well. We'll go into what's happening today. Um, Oil prices specifically are in play today. They've risen. WTI, West Texas Intermediate Crude, rose all the way above $85 a barrel this morning, which has broken its high level for the last 6 months. Now, this is being caused by a few different things. There was an airstrike on an Iranian embassy in Syria, which could escalate and expand that conflict that's in the Middle East right now. Also, a Ukrainian drone strike hit the third largest refinery in Russia, and that's not helping oil prices. So we're seeing these commodities increase in price. Now, these are definitely not going to help us on our fight with inflation because oil and energy plays such a big part in the cost of goods. So that's something to keep a very close eye on where that's going to go. Today's going to be a busy day for existing Fed members. We have four of them speaking today. Member Bowman, Williams, Mester, and Fed President Daly. So, their commentary that's going to come out there will move a little bit of the market this afternoon. The JOLTS report is the big job data that came out today. Now, it's not just the headline number that we need to pay attention to. It's the revision. Once again, we see multiple revisions to the downside that come in way after reports are done, and we just don't get the traction back from those revisions of what happened when those numbers came out. So the JOLTS data showed that job openings contracted. The headline appears to show an increase, but like I said, the story is these negative revisions that just continue to happen. So the January report showed initially showed total JOLTS or job opening labor turnover at 8.863 million job openings. That was revised downward all the way 115,000 to 8.74. The February rose a modest 8,000, but when we look at what the revisions came in at, definitely a less than stellar JOLTS report for today. On a positive note, Corelogic came out with home appreciation. We keep talking about this on why it's so important to get into a home now because of where these prices have been and where they're going. So Corelogic came out and showed prices rose very strongly at 0.7 in February. And that was after falling just ever so slightly 0.1 in December. Now, what's really important is that they initially called for a flat month. So we went from 0 to 0.7 up in appreciation once the number was done. Corelogic is usually a little bit more conservative, and their numbers are many times adjusted upwards once the data falls through. ISM, what hurt us yesterday in the market, gave us a good amount of red, was the ISM manufacturing index. That came in significantly hotter than what we had planned, which caused the market to sell off sharply, specifically in 10-year bonds. The index rose from a rate of 4.78 to 50.3 in March. This was much stronger than the estimates and was a big surprise because manufacturing has been sort of a weak point when it has come to the economy lately. Some of that run-up is kind of a one-off situation because there was an increase overall to inventories. Now, that's going to be a temporary situation. The inventory component rose to a 13-month high of 48.2 from 45.3 in February. If we hadn't had that run-up in inventory, we actually would have remained pretty flat and still in the under 50 index, which is the definition of contraction. So the inventory is, like I said, kind of a one-off situation. We'll wait to see where that goes. When we dig deeper into this report, one of the interesting parts is that prices paid, which is a significant inflation measure, rose from an index of 52.5 all the way to 55.8. That's a pretty big index jump. It's the highest level we've been since 22. And the bond market definitely did not like this. So the Fed futures market is now showing only a 59% chance of a rate cut in June. We keep pushing these rate cuts down the road, down the road, down the road, and going from maybe 3 rate cuts now to 2. So we've got some concerns on that. And that's what's going on, driving yesterday's red in the bond market. Today, we got a little bit of it back, but not enough to really get excited about, unfortunately. So bonds are testing their a Fibonacci level at 100.427. If we don't hold this, the concern is there's a decent run up to the next level of support, which is the 200-day moving average. To avoid this, we're really going to need some weaker numbers, is what we've talked about, in the jobs report tomorrow and on Friday. In fact, ADP raised their guidance from 150,000 jobs to 180,000 jobs. So we're very curious on where that's going to go tomorrow. The 10-year bond right now is a little bit above 4.35, which is the highest mark of the year. We've got a little bit of concern going into these job numbers. We'll stay on top of everything. Give us a call to get pre-approved, help get your offer accepted, leverage our knowledge and our information. The Market Update Desk is the original single source for market news and information in the West Michigan area. Hope you have a great day.